September 15th, 2008. 1:45 in the morning. A 158-year-old bank, one of the most powerful financial institutions on Earth, files for bankruptcy. Within hours, global markets begin to collapse. But here's the thing nobody told you. Lehman Brothers wasn't even the real problem. The real problem was what was hiding behind it. So today I want to talk about something I've been looking into for a while now. And honestly, the more I dug into this, the more I kept thinking, how is nobody making a bigger deal out of this? It's called the shadow banking system. And before you click off, let me just tell you one number. $70 trillion. $70 trillion. That is larger than the GDP of every country on Earth combined. And it operates almost entirely outside the regulatory system that was supposed to prevent another 2008. But here's what gets me. This thing nearly destroyed civilization once already. And it's 3 times bigger now. Now I want to be clear about what shadow banking actually is. Because people hear the word shadow and they think fraud, crime, some underground thing. And it's not exactly that. It's both more boring and somehow much scarier than that. Shadow banking is essentially any financial institution that acts like a bank, takes in money, lends it out, creates credit, but without a banking license, without deposit insurance, without Federal Reserve oversight, without the safety nets that were put in place specifically because we learned the hard way what happens when they're missing. We're talking about money market funds, hedge funds, private equity firms, mortgage companies, insurance vehicles, structured investment vehicles, entities that collectively move more money than every traditional bank in the world. And the kicker? Most people have never heard of any of them. And that's not an accident. So let me walk you through how this actually started. Because this isn't some ancient conspiracy. This has a very specific origin story. And it starts in the 1970s with a problem that banks had. At the time, commercial banks were heavily regulated. There were caps on how much interest they could pay depositors. There were restrictions on where they could invest. And what happened? Sophisticated investors, pension funds, corporations, wealthy individuals started pulling their money out of traditional banks and putting it somewhere that gave them better returns. Enter the money market fund. Invented in 1971. Acts exactly like a bank account. You put money in. You can take money out anytime. Except, and this is the crucial part, it's not insured. It's not regulated like a bank. And for 30 years, that was fine. Because the returns were good and nothing went wrong. And then, of course, everything went wrong. But before we get there, I need to explain how this system grew. Because what happened between the 1970s and 2008 is genuinely one of the most remarkable financial engineering stories in human history. And I mean that in the worst possible way. Shadow banking size in 2002, $26 trillion. Shadow banking size in 2007, $67 trillion. Shadow banking size today, over $70 trillion. Here's what they built. Banks realized they could make a mortgage loan, and instead of holding it, waiting 30 years to collect interest payments, they could bundle thousands of mortgages together, slice them into pieces, and sell those pieces to investors. Mortgage-backed securities, collateralized debt obligations, credit default swaps. And who was buying these things? Not traditional banks, shadow banks, hedge funds, structured investment vehicles operating offshore. Entities that were so technically complex that even the people running them didn't fully understand what was inside them. Now here's where it gets genuinely insane. These shadow institutions were borrowing money short-term, sometimes overnight, and using it to buy these long-term, illiquid assets, which means every single morning, they needed to roll over their debt. Every single morning, they needed someone to lend them money again. And as long as everyone kept doing that, the whole machine kept running. You can probably guess what happened when someone stopped. But here's what I couldn't get over when I was researching this. The people designing these products, the PhDs, the quants, the Nobel Prize winners hired by these firms, they knew. Some of them absolutely knew that the underlying math only worked if housing prices never fell nationally. And they built a $67 trillion system on that assumption anyway. August 9, 2007. BNP Paribas, a major French bank, announces it cannot value 3 of its investment funds. The reason? It cannot find buyers for the assets inside them. The global credit market freezes. Not collapses, freezes. In 24 hours. And almost nobody outside of finance notices. That was the real start of the 2008 crisis. Not Lehman. Lehman was just the moment it became impossible to hide anymore. What was actually happening in those 13 months between August 2007 and September 2008 was a slow-motion bank run on the shadow banking system. Except instead of regular people lining up outside a bank, it was massive financial institutions quietly refusing to lend to each other overnight, refusing to roll over the debt that kept these shadow entities alive. And because these institutions were so interconnected, because the same assets were being used as collateral in 5 different transactions simultaneously, when one thing started to wobble, everything wobbled. The system made one fatal assumption, that it would never have to actually pay everyone back at once. Now let me tell you about the part that really got me. When the crisis hit, the Federal Reserve did something extraordinary. It opened its emergency lending facilities that had only ever existed for traditional, regulated, deposit-taking banks, to shadow institutions. It lent money to investment banks, to money market funds, to entities that had spent decades arguing they didn't need regulation because they didn't need government backstops. The Fed ultimately committed over $7.7 trillion in emergency loans and guarantees during the crisis. Most of that went to shadow banking entities. Most of it has never been properly accounted for publicly. So let me just be direct about what that means. These were institutions that took on enormous risks specifically because they operated outside the regulatory system. And when that risk blew up, the public, through the Fed, through TARP, through 100 other mechanisms, absorbed the losses, while the upside, during the good years, had gone entirely to private investors. Profits, private. Losses, public. That's the shadow banking business model. And I'm not editorializing here. That's just what happened. But that was just the beginning of the problem. Because what happened after 2008 is honestly the more alarming story. After 2008, there was a moment, a very brief moment, where it looked like things might actually change. Dodd-Frank passed in 2010. New rules, new oversight bodies, new stress tests for big banks. And for a minute, it felt like maybe the lesson had actually been learned. But here's what Dodd-Frank couldn't fix. It regulated banks. It couldn't regulate the incentive for money to leave banks and go somewhere less regulated. And that's exactly what happened. In the decade after 2008, as traditional banks got more scrutiny, as capital requirements went up, as compliance costs rose, the shadow banking system didn't shrink. It grew. Massively. Private equity firms started doing mortgage lending. Hedge funds started doing corporate lending. Fintech companies started doing consumer lending. All of them operating in the space between traditional banking regulation and actual consumer protection. And here's what nobody wants to say out loud. A lot of the money flowing through this system right now, your money, is in it. If you have a pension, there's a very good chance some portion of it is invested in private credit funds, shadow banking instruments. If you have a 401k, your money market fund is a shadow banking product. If you've ever taken out a mortgage in the last 15 years, there's a reasonable chance it was originated by a non-bank lender, a shadow bank, and sold into a securitization vehicle that no regulator has real-time visibility into. This isn't theoretical. This is where your retirement lives. 75% of U.S. mortgages were originated by non-bank lenders in 2023. The private credit market is now $1.7 trillion. It doubled since 2019. Now I want to talk about the specific thing that's been keeping economists up at night. Because it's not the same risk as 2008. The asset classes are different. The instruments are different, but the underlying structure, borrowing short, lending long, with minimal transparency and maximum leverage, that's identical. Private credit funds are lending to companies that can't get traditional bank loans, which means they're lending to riskier borrowers at higher rates, using money they've raised from pension funds and institutional investors. And these loans are illiquid. They can't be sold quickly if something goes wrong. There's no market for them, which means if those companies start defaulting, and in a high interest rate environment, some of them will, there's no clean exit. The system made the same bet again, and nobody is required to tell you that. And here's the part of this story that I genuinely struggled with. Because the people running these funds, they're not bad people, most of them. They're doing what the incentive structure rewards. They raise more money. They deploy more money. They collect management fees on more money. The risk lands on the pension beneficiaries and the taxpayers. The fees land on the fund managers. That's the system. It's perfectly legal. And it's been perfectly legal every single time it's blown up. So where does that leave us? Honestly, I've been sitting with that question for a while now. Because there's a version of this story that ends with some neat policy prescription. New regulation, new oversight body, problem solved. And I don't think that's the honest version. The honest version is that the shadow banking system exists because of a fundamental tension in finance that nobody has figured out how to resolve. Regulation creates safety. Safety reduces returns. Low returns push money toward less regulated spaces, which creates new risk, which eventually requires another bailout. Repeat. What changed after 2008 is that we now know, with certainty, that too big to fail applies to shadow banks too. The Fed proved it. So the implicit government guarantee, the understanding that if things get bad enough, the public will absorb the losses, now extends to an unregulated $70 trillion system. Without the disclosure requirements, without the capital buffers, without the oversight that the guarantee is supposed to come with. What hasn't changed is who ends up holding the bag when it goes wrong. The people I kept thinking about while I was pulling all of this together weren't the hedge fund managers or the central bankers. It was the retired teacher whose pension has 15% allocated to private credit funds she's never heard of. The 34-year-old with a 401k sitting in a money market fund that has no deposit insurance. The person who took a mortgage from a non-bank lender in 2022 and has no idea what entity actually owns their loan today. These people are not ignorant. They're just operating inside a system that was specifically designed to be too complex to see clearly. And I think that's the part of this story that actually matters. Because the shadow banking system isn't going away. It's growing. It will keep growing. And the next time it creates a crisis, and if history is any guide, there will be a next time. The question of who understood what it was and who didn't is going to matter a great deal. So now you know. What you do with that is up to you. They built a $70 trillion system on the assumption that nothing would ever go wrong at the same time. They were wrong once. And nobody went to prison. And it's bigger now.